Good evening. Welcome to the market review by the bottom line. And this is the market review as of the end of April month. A lot has happened geopolitically, a lot has happened in terms of the energy prices. So I want to cover a few set of important topics in this month's update and where all do I see the pockets of investment opportunities, and if I have to time it, how am I looking at the valuations data. So broadly, we'll cover these topics today: the Nifty valuations, the system liquidity, and the interest rate trajectory as usual, and one or two key points to monitor. What happened in the RBI policy update and why is it important for us to keep a view and keep a watch of that update. And the last topic we'll cover is the market breadth improvement, which I'm tracking for the past 3 months, and we're seeing a good amount of improvement in the market breadth. If we look at the Nifty valuations, we are currently just mildly above the median line, which means it's slightly overvalued, right? It does not mean this is an exit for the entire portfolio for me, but it is slightly overvalued. So do I take chances in stocks at this point of time? Absolutely not. This is the line that I use to ensure that if I'm below it, I'm comfortable investing in some of the quality stocks. Uh, if if we are below that line, it's fine. But if we are above that line, then there is no activity for me in the market, right? Still, the valuations are between fair and overvaluation, but it's closer to the fair area, right? So we need to see the earnings improvement in the short term. It's going to be very tricky with the crude oil prices being at around $117 a barrel now. And it's going to be slightly tough for the Indian incorporation to, especially which are energy dependent, those industries to do well and clock good amount of earnings. But we'll see as the March uh, earnings quarter results come out. Uh, in the system liquidity, the RBI has reduced its liquidity a little bit, uh, which means they have sold a few bonds in the markets and pulled back a little bit of the rupee currency. It's not a lot, but it is giving a little bit of hint because, like I said, RBI had two choices. One, they look at this inflation and they see the energy prices rising, they see a weak monsoon forecast, and they increase the interest rates, but that would have been really harsh on the economy. So the other choice that they had is reduce the system liquidity by a little bit. We may see a little bit of more reduction as well in the system liquidity. By how much, there's no exact number to it, but the trajectory says that there could be liquidity, you know, tightening so that the inflation does not go uh, too much haywire, irrespective of things that are going on. Interest rates were kept unchanged, which was a good thing, looking at everything that's going around. But if things become really tough in terms of inflation, in terms of the levels that are around, it can be extremely difficult to manage that inflation without increasing the interest rates. So it's going to be a tricky year for RBI, a tricky year and a half, I would say, for RBI to come up with the right policy decisions. But we cannot predict everything, so we'll have to take every single bi-monthly monetary policy, understand what they have done, and understand what the tone looks like. The two key points to monitor right now, at least what I'm seeing, is the crude oil prices. Like we said, the crude oil prices are close to at about $117 a barrel, which is quite a bit. It was about $70 a barrel a few months ago. Um, Generally, $80 a barrel is considered to be a general comfort level for most economies. But since we are very highly dependent on crude oil imports, our companies are highly dependent, our energy dependency is on that, transportation is dependent on that. You and me depend on our office travels on crude oil. So a lot is dependent on it. And if uh, these prices don't back down and they remain elevated for a really long time, maybe 3 to 6 months, it could really hurt the economy. It could really hurt um, the the fiscal deficit that we have. And frankly, what happens when the fiscal deficit rises? It's very simple. You would want someone to fund that fiscal deficit. Now, how would you fund that fiscal deficit? The government will ask the Reserve Bank to print that much amount of money. When that much amount of money is printed and put back into the economy, or rather given to the government to cover the deficit, what happens to your purchasing power? It reduces. The value of the currency drastically reduces when you print more of it, right? So it affects your life as well, and it affects the amount of savings that you have and the purchasing power of those savings that you've got. And so that's a very important point for me to watch out for. The second thing is the 10-year bond yields. Uh, I'm a firm believer that at lower bond yields, the equity markets will perform extremely well, frankly, because there has to be incentive for the investors to come back to the equity markets. Right now, the yield on Nifty is close to 4.5%, and the yields that bonds are providing are close to 7% on a 10-year bond. In very simple terms, for all the additional risk that I am taking for investing in the equity markets, the returns are predicted to be lower than the bonds. So you and me as investors, the FIIs, forget the DIs, I'll not consider um, largely here because DIs do a lot of work of mopping up what FIIs are selling off so that the market doesn't fall a lot. But I'm looking at FII data, they're still net sellers on the Indian markets. And frankly, that says a lot, right? If the bonds are giving me 7% and the equity market yields are around 4%, I'd invest in a bond, which is much more safer until the equity markets are able to provide me with an equity risk premium, which rewards me for the risk, the additional risk that I'm going to take. So it will be interesting to see as the interest rates rise up, these bond yields will have to adjust themselves. But the RBI policy and the update had an important thing mentioned about inflation, which is really going to affect the bond yields. Now, the RBI policy update was a good one. I think the the bank's rate were not um, increased. It was a very, I would say, a very good decision to not hike the interest rates immediately. So we are taking a little bit of time, but things in the bottom right corner don't look good. If you look at the quarterly projections of CPI, we're going from 4% to about 4.4 to 5.2%, which means there is no interest rate reduction coming in this entire year, right? There are high chances of an interest rate hike, which the RBI is trying to avoid, but most likely they will have to, is my view, at least by a 25 basis point or a 50 basis point if the inflation goes way beyond 5%. But we will only be able to know that as situations develop. We're not seeing any hit on the real GDP growth. The real GDP growth still needs to move uh, way beyond 7% for us to continue the strong growth. But we can't do it at this point. Frankly speaking, uh, we are extremely hammered with all the conditions that are not conducive for us right now. So inflation will be very important to watch. Market breadth. Uh, this is something that I track very religiously. Stocks trading above 200 DMA, the long-term moving average. If you see, this number was about 23% of the stocks. Only 23% of the stocks were above the 200 DMA. We had that moved to 27% in March, and by the end of April, as of yesterday, I think it has moved to about 55%. And that is a very strong improvement, in my opinion, in terms of the price action for stocks becoming going well above 200 DMA. It will be interesting to see how this develops as we move ahead. We want this 55 number to go to 70. And in a pure bull market, you'll see almost 90% of the stocks well above, trading well above the 200 DMA. I'm not expecting an immediate bull market at this point, but we'll have to be very prudent. Any new investments that in any of the sectors that I'm making are purely based on quality and purely based on one important factor, that the valuations of Nifty are lower than the median prices. With that, I think that's all I wanted to cover for today. Thank you so much for your time, and I'll see you in the next month end update.